When it comes to high yield dividend ETFs, there's one ETF in particular, QYLD, that I feel is probably one of the most popular dividend ETFs there are. And QYLD, the Global X NASDAQ 100 Covered Call ETF, is probably so popular for a few reasons. It pays monthly, it offers a high yield, and the investment strategy is very simple. However, there are a few reasons why I don't believe that this is a great ETF to invest in. So I'm going to go over some of those reasons and maybe a reason why this ETF may be okay to invest in. And before we get into it, if you could leave this video a like to get this content out there and also subscribe for future content, it will be much appreciated. A little bit about QYLD as an overview. QYLD seeks to generate income through covered call writing, which historically produces higher yields in periods of volatility. QYLD pays monthly distributions, which is great for dividend frequency. I feel that that is a reason why a lot of dividend investors prefer monthly distributions, because it is always that great feeling of frequently seeing dividends hit your account. And about its simple approach. So QYLD writes call options on the NASDAQ 100 index, saving investors the time and potential expense of doing so individually. More of a technical overview, the ETF has a net assets under management of 8.15 billion, total expense ratio of 0.61%. And now this is actually pretty surprising. I think this is somewhat unfair considering how simple the strategy is. So that expense ratio, I believe, is pretty high, and a distribution yield of around 12%. Now this is going to fluctuate, but you are expected to get a very high dividend overall. Now overall, the ETF seeks to track the performance of the CBOE NASDAQ 100, a buy rate V2 index. Now it is a pretty wordy summary, but I'm going to sum it as what this ETF does is it holds NASDAQ 100, the index itself, and then simply sells a covered call 1 month out at the money to generate options income for the investor. Now, because covered calls take such a front row seat in the investment strategy of this ETF, I need to tell you a brief overview of how a covered call operates. So from this fun page here, this infographic that Global X published, the seller of an option must sell the security at that strike price if the buyer chooses to exercise the option. So basically what happens is this ETF is selling those covered calls at the money. So we can use a hypothetical price of $100 per share it's currently trading at. This ETF will sell a call option at $100 per share. Now, if that price goes above $100 or $102, let's just say, then the fund is obligated to sell that underlying asset at $100 per share. Doesn't matter how much it goes up to, could go up to $3,000. The fund is obligated to sell it at $100 per share. So why is that important that a seller is obligated to sell at that predetermined price? Well, covered call strategy inherently forfeit upside in exchange for current income. Therefore, covered call strategies can be used strategically in income-focused portfolios or tactically for investors who believe the markets are unlikely to rise. In other words, if an asset increases in price, a covered call will basically limit the upside potential of those capital gains. At the same time, you will receive income from that covered call, but usually it's not enough to offset that upside in capital gain. Conversely, it could be good if you expect the underlying to decrease in value because you are keeping the premium, but there's also other risks to that too, which I will get into. Now, I think something that people overlook with covered calls because they are seen as a way to mitigate losses is that you are still exposed to price decreases in the underlying asset. So in other words, if the NASDAQ 100 index doesn't perform well and goes down in value 20 to 30%, there's a very good chance that the covered calls that this option is giving you, the income that you're receiving, is not going to make up for those capital losses. an investor is pretty much entirely liable for all of the losses the underlying will have. And that covered call will not help you if the underlying drops 20 to 30%. It's not going to make up for it. A very simple way to illustrate this is the single day performance of the Invesco QQQ ETF, which is an ETF that tracks the performance of the NASDAQ 100. As you can see, the ETF is fairly red for the day, down over 1%. And QYLD is down about 0.33%. Didn't do as poorly as QQQ did, of course, because you are profiting from that covered call. However, at the same time, if the QQQ or the NASDAQ 100 does really poorly over a month or two, then this ETF will also suffer very badly too. And that variance that you see currently is not going to stay the same. So let me show you what I mean with that. So on November 19, 2021, the S&P 500 hit at that time a local high, and I believe it was the highest it's been for that period at that time. And then it slowly dropped as the fears of the market became prevalent. So from November 19, 2021 to December 30th, 2022, the NASDAQ 100 ETF QQQ fell 34%. So keep that in mind, and then we are going to go to QYLD. Now this is QYLD's chart for the past 5 years. So if we go to that same point, which I believe, if I remember correctly, was November 19, 2021, and then we go to December 30th, 2022, you see that QYLD, the underlying, fell by 31%. So that didn't really help you too much in regards with capital depreciation. You may be thinking to yourself, well, I made up for that with covered calls, and this is just not true. It lost quite a bit of value even with those dividends reinvested. And unfortunately, it captured pretty much none of the upside of QQQ after that decrease in price since 2021. It didn't really recoup the value at all. And what I mean by that is that QQQ had a pretty good run since that period, up over 65%, while the underlying of QYLD is just diminished to pretty much nothing. So that is pretty much the first reason of why I don't think this ETF is that good, because you are still exposed to complete downside pretty much of the underlying if the underlying drops. Now, yes, you are going to be receiving that options premium, but that is not going to save you from the decrease in your share price over time. And that is also pretty much reason number 2 as well, because you're using this covered call strategy that sells at the money call options, you are not going to be receiving that upside. So remember how I said that covered calls will limit your upside? That is a perfect example of why QYLD never really recovered, because the fund is just going to keep writing covered calls at the money as it's designed, and you're going to be selling your shares away at the money with every asset increase over time. So QQQ did very well because it wasn't selling those calls and you're able to capture all of that growth. QYLD did pretty poorly because it was selling covered calls and you couldn't capture that growth because they were obligated to sell every time the share price broke whatever it was at the money. Reason number 3 why I hate this ETF is that it doesn't really perform well with dividends even reinvested. So what I did was I took a hypothetical $500,000, invested that into both the ETF QYLD and another popular ETF SCHD. Just an example, I know these ETFs operate with different investment strategies. One is to give you high yield. The other is to provide capital appreciation, high yield, and also dividend growth. But I just wanted to show you a comparison with another popular dividend ETF, and this is going to go back to December 31st, 2013. So as you could see, and as you could expect, SCHD rose quite a bit in share price during that time. The underlying asset definitely increased, and your total portfolio value did increase as well. Same with QYLD. Your portfolio basically doubled with those dividends reinvested during that period. And it also offered quite a bit less standard deviation with those dividend reinvested as well. But SCHD shot up in value 3 times its original value. So definitely a better performance overall. And you may say, well, okay, I'm fine with that because I want to make a lot of income. Well, the point generally to make a high amount of income using yield is to pretty much live off of those dividends. So a lot of the people that invest in this ETF have the intention of using that income to live off of. In other words, they're not going to be reinvesting their dividends most of their time, because as this shows, if you're not living off of your income, what's the point of owning this ETF? Because there's better choices. Just to have high yield dividends doesn't really make much sense, because you could get other ETFs that will grow in value over time, increase their dividends, and also pay you a decent dividend along the way. No, what a lot of people do is they use it to live off of the income. So let's do a back test without the dividends reinvested. Now this is a back test of the ETFs without the dividends reinvested. So SCHD still doubled its value over time, even if you are using those dividends for whatever you want, while QYLD decreased in value by about $150,000. So it's great that you got that income to live off of during that time. About a 12% yield from $500,000 would be roughly 60 grand a year. So that would be pretty good, especially for holding it for all that time. You would have the necessary income you would need to live off of. But if you're younger, I showed you even with the dividends reinvested, it doesn't really work well. And if you're younger, then you're probably not using this ETF to live off of. So what's the point? You could basically go with another ETF and you could go with a different ETF and get a better investing situation as a whole. So that is pretty much like the fourth reason why I hate this ETF, is that if you're using it as it's intended, then you are going to lose capital over time if you are living off of those dividends. Now that's going to segue into the positive. So who would this ETF benefit? Well, it would definitely benefit somebody that wants to live off of income. As this shows, if you put in initially $500,000, you would basically lose money over time. But this past 10 years, you got steady income over time as well. So if you're somebody that's hypothetically 70, 75, 80, and you need income now and you don't have that much capital to invest, then this ETF may suit you pretty well. But for anybody, I would say, that doesn't have a huge amount of assets already or that is young, you should not be investing in this ETF at all. Look elsewhere. There are a lot better choices. Let me know in the comments section below if anybody owned this ETF and then sold it at one point or another, or if you do own it, is it working well for you? I hope that gave you a decent overview of the ETF as a whole and why I don't enjoy it. Maybe it gave you considerations as well. Remember, if you did enjoy this content, leave this video a like to get this content out there, and also subscribe for future content, and I'll see you all in the next video.